a lot of people still believe that you have to put 20% down to buy a house, or they're just absolutely scared of the idea of this mortgage insurance. Just because you can be approved doesn't mean you should.
Yeah.
And it's the same thing with a house. Don't quit your job. Don't change jobs. Because again, going back to being able to qualify for a specific home, if you quit your job or if you change jobs, can you get approved?
Well, welcome to the Beyond Wealth podcast, Aaron Jensen.
What's going on?
You flew in just in time to
Flew in from my Tacoma.
from the Toyota Tacoma. So I have a Tundra actually, and
Okay.
I'm jealous of your Tacoma because I don't really like driving a big truck.
Okay.
When you need it, like, because on some of my rehabs and different things,
Right.
when you load up like a pallet of vinyl flooring,
Right.
you're like, I'm really glad I have the truck. Every other time, like parking it, I'm like, this is the worst.
So I had a thought process when I went into buying my truck because I knew I wanted a truck. I came from a Land Rover Discovery, just like an old beat up Discovery, and I was like, man, I've wanted a truck for so long, but I don't want a big truck. And so I heard someone say like maybe a year or two ago, a Tacoma is a city truck.
Yes.
It's a truck, but it's kind of like it's a truck.
I mean, at the end of the day, I think you can do probably 80% of the jobs that you can do with a big truck.
1,000%. I mean, I have maybe on the weekends every once in a while I've used for the actual truck, but when you don't have a truck and there's no access to a bed, you really want a truck. And so it feels like a car on the inside, but you've got the bed if you need it.
It's helpful.
Not to mention like Toyota's like the best out there. Let's be honest,
Yeah. No, I mean, I'm a huge Toyota
It's like
fan.
a commercial for Toyota.
I know.
Right?
Yeah. The podcast is really about Toyota. So we've known each other for a while, and you've been in mortgage lending for a good bit now. And we connected, which was funny. About a while ago, you were, the early idea of a podcast, we did something online, like back and forth.
That's right.
Talked about our planners.
Was that before you started the podcast?
Yeah, that was well before. It was like
wow.
before I even was doing the Cash Flow Bros with the guys or anything well before that. Okay. So thanks. But we're actually in person now, so that's awesome. But I wanted to bring you in because you know a lot about lending. You've been doing it for a good bit now, and I've always loved your approach. A lot of it is education that you do online through TikTok and Instagram and stuff, but you have a lot of ways that you tackle, I think, some of the complex things of lending and make them like palatable for people to understand. Yeah. And so I wanted to talk through like some of that, some of first-time home buyers' do's, don'ts. Okay. I know we have some updates on NAR and how lending might be providing some solutions for that. But let's start with that. Talk about some of the common like things that when a person comes to you and they're like, hey, we want to buy a home. And you're like, hey, do these things and don't do these things in this timeline of trying to buy a house.
Yeah, what's funny about that is like a lot of times as lenders and people in real estate, really, you have the thought of like, do I really need to say this? Do I you probably already know this, but they don't.
Yeah,
like they really don't. Like a lot of people still believe that you have to put 20% down to buy a house. Or they're just absolutely scared of the idea of this, this mortgage insurance, which, I mean, nobody likes to pay mortgage insurance. But for some people, it's like $40, $50 a month. It's nothing crazy. And the difference in putting 20% down and paying an extra, $40 to $50 a month, it's a no-brainer for a lot of first-time home buyers.
And mortgage insurance can be taken off.
Yes.
Yeah, I mean, you have to take some steps. They don't want you to take the steps. But at the end of the day, it's really simple.
It is. Just, I mean, if we want to like kind of step off to the side here, talk about that. If you have mortgage insurance, all you need to do is contact your servicer and let them know that you want to get that removed off of your mortgage payment. If you've got at least 20% equity, some of the servicers will only let you do it if you've had the loan for 2 years. So that is an important note. So along with having 20% equity, a lot of them say, we need you to have this loan for at least 2 years. All they'll do is they'll send out an appraiser. Most of the time, it'll just be a drive-by appraisal. So literally, the guy will just pull up.
House is still there.
Yeah, house is still there. They'll take a look at the comps, make sure all that. They'll even ask you, did you do any renovations on the inside? And for us, like we bought our house and completely renovated our kitchen. And so there was a major update there. So with that being said, then they'll evaluate, and as long as the appraiser comes back and says, yeah, this thing is worth this amount of money, this is how much the loan amount is, you got 20% equity, you can remove that mortgage insurance.
Yeah, and you're paying an appraisal fee and you're out. And that is the thing, is like when people sign up for it, they think, oh, I'm into this for 30 years. And you're like, you're not.
You're not.
So
yeah.
So that's one big thing. 20%. Yeah. What else?
Yeah, going back to the original question. So do's and don'ts: don't open a new line of credit while you're in the mortgage process, because if you do that, let's say your debt to income, that's a huge ordeal with getting approved, is your debt to income, how much you're bringing in monthly versus how many monthly debts you have. So if you go in and open a line of credit, let's say you buy a car, whatever, if you do that, you could totally throw off your approval amount. So it doesn't mean that you're completely not approved for a home anymore, but if you're under contract on a specific home and you go and open a line of credit, you may not be approved for that home anymore. So now you got to start the entire process over because you opened a line of credit.
Now, what about closing line of credit? Does that affect your credit score?
That's a little bit gray. It does affect your credit score. However, will the lender pull credit again before you close? Some loan programs require you to do like a soft pull right before you close, and some don't. But I would stay away from that altogether. However, what you can do is you can close out a line of credit, let's say like an installment loan. You can actually apply that at the closing table. So your lender says, hey, do you want to pay off any debt at the closing table? You say, yeah, I actually have a car loan that I want to get paid off. Don't pay it off before, because another thing is it's more documentation for you that you have to provide the lender. Go ahead and just apply it at closing. So you get the payoff details from your, we're using the example of a car loan. You get the payoff details from your loan provider for your car, provide that to your mortgage lender, and you can actually pay that debt off at closing.
And what would be the benefit of that?
Yeah, sure. So the benefit of that is that you could lessen your debt to income with your mortgage lender.
So at that point, they're saying, if you pay off this car, you're approved for this loan.
Yep.
But we don't want you to do it until that point, because it's going to jostle all the credit score and the numbers and everything.
Well, the main thing is just it's going to make it a lot harder on yourself and the lender for documentation purposes.
I see.
So go ahead and just get the payoff and then do it at closing. So now we don't have to document like where'd that money come from that you used to pay off that loan, all that sort of stuff. Because it's going to be done at closing, we already know what your assets look like. We already know what your debt looks like. So just get the payoff for it and apply it at closing, and just it's simplified. But yeah, you can. I mean, I'm actually having a client do that right now, where they can afford this house on one of their incomes just by paying off a car loan. So they're going to pay that car loan off at closing. So therefore, we can completely remove that from their debt to income.
That's awesome. Mm-hmm. Tell me, so if I have credit cards open, zero drawn on them.
Okay.
Does that go towards my debt to income ratio?
No.
Okay.
Yeah, if you've got $0, like if you're not using that credit card at all, then there's nothing that we can need to account for. However, I will say on the back side of that, if you've got credit cards that you're not using, you're probably not getting the best out of your credit. Because as long as you're using your credit card below 30% of whatever your limit is, that's going to increase your credit score. But if you've got open lines of credit that you're not using, that's actually hurting your credit score.
Right.
But as far as a debt to income situation, yeah, we don't have to account for that at all.
It's an interesting thing too, because don't get me wrong, I think credit score is valuable and all that, but I like to play within margin. And everybody's like, does this affect credit score? Does this affect credit score? And it does, but like I would rather just my credit score be so good
Yeah.
that if it takes a 15-point drop, it's not doomsday.
Right.
And I know everybody's not there, and
Right.
it takes time to build there, but I think that with good, consistent decisions, you can get there to where there's margin and you can have a little bit of play and you can do a credit. Like, I'm not worried about a credit pull.
Yeah.
I pull my credit if I need to pull my credit.
Right.
It's the small ding on it is not going to change my world. You know?
Yeah.
So, I wanted to talk about and ask questions. What are the credit score breakdowns for, it may be a variable that is not like a clear answer, but rough windows of credit scores where rates start to increase and you don't have I know that if you have an 800, you're getting the best potential rate.
Yeah.
But as you go down, points get added on your rate, correct?
Yeah. Yeah. So there's actually a whole, really confusing if you're not used to seeing it all the time.
He's like, let me bring up my chart.
Yeah, let me show you the graph. But there's a thing called LLPAs, which are loan level price adjustments. And basically what that means is exactly what you're saying. If you're putting this amount of but the thing is attached as your down payment as well. So your credit score plus your down payment. Okay. And so if you're anywhere from 780 to beyond, there's not going to be that much difference. So if you're at a 780 and your credit score, and then someone else is at an 812, you're looking at a similar situation. So you don't have much bragging rights beyond just the fact that your credit score is higher. But there's not much benefit beyond that. Below that is 720 to 780 is kind of that other
second tier.
Yeah. Okay. Tier.
Citizen, if you will.
Yeah. Below that, I would say 640 to that 719. You're kind of looking at a different tier. There's other adjustments within there as well, but below 640 is a major drop. Now we can get you approved for below that 580 is the minimum credit score, but you're going to pay for the fact that your credit score is below a 640. So yeah, I would definitely say there's a lot of things that you can do to get your credit up to 640, and it depends on everyone's different scenario. But a lot of times when I see people with that 620, 635 credit score, it's their credit cards. I'm not saying that's always the fact, but a lot of times when you've got 30-day late payments left and right, you're probably in the 500 range or below. But if you're sitting at a 620, 635 credit score, first thing I'm going to look at is your credit cards. Is your utilization too high? So if your limit is $1,000 and you're sitting at $800, $850 usage of that credit card, all we got to do is get you to pay down to $300. You're going to see your credit score jump.
Or could you do the reverse and get more credit limit?
You can. So that's the second part of that is if you don't have the ability to pay that down, you can call your credit card company and say, hey, I want to increase my limit. Or hey, I use $800, because a lot of people, it's not that they're struggling to pay it down. It's the fact that they know next month they use that credit card for the same purposes, and $800 is the amount they use every single month.
Right.
So instead of paying it down, just increase your limit to $5,000 or $2,000. You need to look at your options there.
Yeah, I have a rolling credit line. I put everything on the credit card and paid off at the end of the month. Give me points,
Yeah.
And my rolling budget is, well over $800.
Right. That's another podcast we need to talk about.
Yeah. How to have it's the kids, right?
Yeah, right. Blame it on the kids.
But no, I didn't know that about the 30%. So you want to hover around that 30% to maximize your credit limit.
Yeah,
which is interesting, because I think on some of my rolling, I could do the numbers and just try to get the increase to stay in that 30% range. Yeah. I don't think I am. I think I'm probably at a 50% to 75% usage on that one specific
and it's
card.
Crazy. Just 2 weeks ago, I helped someone get their credit. I'm trying to remember what it was. He had a 670, and I got him just over a 700 just by paying down $200 on a credit card.
Wow.
And it affected his interest rate.
It's so interesting, the game.
It is. It is a game.
It's
let's be honest here. We're all in the game of credit.
Yeah, it's There's rules to it, and if
Yeah.
you know the rules, you can play the game and you can
It's like
figure it out.
taxes, right?
Yeah, 100%. I've always said that, when it comes to investing and different things like that, the first part of the game is getting the money.
Yeah.
Second part is keeping it.
Yeah.
The tax game and knowing code and like how you can move stuff and trusts and
Yeah.
I mean, it's a whole nother complex thing. So, all right, so let's circle back. So, don't buy a boat right before you try to buy a house.
Yeah.
Lines of credit. Anything else
Don't.
that you should not do?
Don't quit your job. Don't change jobs. Because again, going back to being able to qualify for a specific home, if you quit your job or if you change jobs, can you get approved? Yes, you can.
Makes your job a lot harder.
Yeah, it makes your job a lot harder. But like, what if you're making $100,000 at your current job, and then you switch to a job that you make $85,000?
Yeah.
Well, first off, the underwriter is going to be like, "Hey, why did you switch jobs to a lower paying job?" Which again, does it kill it? No, it doesn't kill it, but it makes things a little bit more difficult. And you may not qualify for that specific home anymore because you change. Or here's another thing. If you're currently, and this has happened before, if you're sitting at a job that you're a W-2 employee, you make $80,000 a year, and then you get this other, job offer where they say, "Hey, you can make upwards of $150,000 a year, but it's 1099." You just killed your deal, because with a 1099 or self-employed or contractor or whatever, we need a 2-year average of your employment because it's going to be a variable versus a salary employee. And so we can't qualify you at that point because you changed how you got paid. So I will say, just wait till you close on the house, and then you
do what you need to do.
Do what you need to do as far as changing employment.
Yeah. But no, I actually had a client and we were in early discussions, okay? And it was December, right?
Yep.
So wintertime. And they were just kind of talking about their life. They're like, we want to buy a house.
Yeah.
And then he mentioned, he was like, and I'm also going to, leave my W-2 and go work freelance.
Yeah.
And I said, time out. I said, the first thing you need to do, is buy the house first.
Yeah.
Before you leave that W-2, because you won't be able to prove your income.
Yeah.
And so we went on the house hunt and found them a house within a week. And killer house. It was not rushed by any means, but because they knew what they wanted and they already kind of knew price point and all that kind of stuff. But I mean, we got them pre-approved, found a house under contract within a week. It was a wild ride.
Yeah.
But it was all came from a conversation of like, what are your life goals?
Right.
And pause, time out. If this is your life goal to buy a house and also to be a freelancer, well, we need to do it in the right order.
Yeah. What's your goal for right now? Because those don't mix.
Yeah. And Jordan, a lender we know well, has posted, and I love the post, and I kind of jumped on the coattails of it, but it's never too early to talk to a mortgage lender like yourself.
Yeah.
Because say you even want to buy, the thought is, I want to buy a house in like 2 years.
Yeah.
What if I did want to go freelance?
Mm-hmm.
I could do that, have 2 years of income, and buy that house in 2 years.
Yeah, sure.
But if I didn't know that information by listening to this podcast or talking to a mortgage lender, I could say, I'm going to wait on that transition of freelance, do it in a year, and then a year later expect to buy a home and find out, nope, you got to wait a whole nother year.
Yeah, yeah.
And so your life plans and all that kind of stuff, just like talking to a financial advisor, like talking to a doctor about your health, like talking to a mortgage lender about this area of, I want to buy a house. How am I going to fund it is so key.
Yeah.
And doing it early.
Yeah. And one of the things that a lot of people are scared of with talking to a lender, the question is, are they going to pull my credit? And that's what people are scared. Everyone's so scared of getting their credit pulled. So you need to make sure that you're working with a lender that will do a soft pull on your credit first, which is what we do. We do a soft pull when someone's looking to like get pre-approved over the weekend because they're looking to put an offer on Monday or something. We'll go ahead and do the hard pull on their credit. But when we're just starting the application process, and I don't have enough information to know that they're going to get, pre-approved right away, we'll just start with a soft pull, take a look at the credit, see what kind of debt versus your income that you're working with, and be able to have those conversations on the front end versus doing the hard pull And then, the thing that you're scared of, it lowering your credit score, doesn't happen with a soft pull. So I would definitely advise, like, if you just want to start the process of like, hey, I might buy a house in the next 12 months or 18 months or whatever, go ahead and talk to the lender, do a soft pull application, just so that you can have those, initial conversations that take place.
Yeah. And then just clarify with the lender, hey, I want it to be a soft pull. And this is just a preliminary I'm trying to figure out, because you could want to pivot jobs. You could want to, because you could find out, hey, we're only approved for 200,000.
Yeah.
And we got 2 kids, and the school system we want to be in, we need at least 300K. Well, you got to figure out more money.
Right.
Like at the end of the day. So in 2 years, that could give you time to build a career to get to the income that you need to buy that 300.
That's exactly right. So, I had one of those conversations last night where we did a preliminary. She called me and said this is what their goal was. I was able to look at their income versus their debt and all that sort of stuff. And she's not looking to buy in the next 6 months, so we don't have to do a hard pull right now. And she said, what's my next step? And I was like, well, you're pretty close to paying off this car. Why don't you just go ahead and tackle that? Her car payment was like $400 a month. How much $400 a month is going to open up so much. It's going to get them where they want to be as far as purchase price.
Right.
So we're able to have those conversations without doing a hard pull.
So I'm curious, as a mortgage lender, and I have my own opinions about it.
Oh, geez.
Car debt.
Yeah.
Do you love it, hate it? Like, I feel like it probably gets people in trouble a lot more than it should.
I feel like there's like opinions that you can have about it. I
like this podcast to be spicy. Okay.
Okay. All right. So if we're going spicy,
we can have opinions. I think it's, from an investor standpoint, I'll say this.
Yeah.
I'll get spicy first.
Okay.
I'll get opinionated. From an investor standpoint, I think of assets and liabilities, and cars are clearly liabilities, unless you have a company, you're doing the Turo thing, which even then I think is borderline. It may still be a liability,
right?
But I think that also it's similar to a house. It can be a little bit of status. It is a little bit of an easier stair step to being like feeling like a lifestyle or this is comfortable, or I need it, and a lot of people think safety and like I've got to have a safe car, so then they justify like putting down that money, and so it gets people, I think, potentially some people into rougher situations financially than they expected.
Yeah.
But I'm curious from a mortgage, because you look at a lot of people's financials.
Yeah.
What are some of the things that you see consistently being roadblocks to their success in buying a home?
Yeah. I mean, the first thing I'll say is you would be surprised how many people making $40,000 a year, which nothing wrong with making $40,000 a year. I used to work at a church, so I'm very well aware of, $40,000 a year, have $700 car payments. If you're making $40,000 a year, you should not have a $700 car payment. It just doesn't make sense. You're trying to prove something, whatever that may be. I really struggle with the fact that, and the thing is, like, people get upset, right? As a mortgage lender, again, I feel like I guess my uncomfortableness in this conversation tells you how much I try and prevent from being an opinionated person.
Right.
But since we're sharing,
but the question goes back to, and I'll be, how does someone who makes $40K get approved to make $700 payments? And I think that's
a great question, Todd.
I think it borderlines on predatory loans.
Yeah, and it happens.
And it happens a lot. I've had renters who literally came to me and said, I can't make my renter's payment.
Yeah.
And I was like, okay, let's talk about your finances. Why can't you make? Because you were making it before. Oh, well, car broke down, so we went out and got a new car. They had a nicer car than I had.
Right.
I mean, literally.
Right.
And I'm like, you need to get rid of that car. I'm sorry to say, but like at this point, it's either a car or a roof over your kids' heads.
Yeah.
Which do you want to pick?
Yeah.
But someone at some, car dealership said, sure, you can afford this, and they could not.
Right. I mean, it really goes back to like, just because you can be approved doesn't mean you should.
Yeah.
And it's the same thing with a house.
Correct. Oh, man, that's good.
Like, there's a lot of people that like, so I was working with a client, and one of the first questions I asked them is, what is your ideal payment? Not what can you be approved for, but what's your ideal payment? I told them, and then they actually went to another lender and said, we're going to go with this lender because they can get me approved for that much, for this much. And I said, whoa, I can get you approved for that much. You told me what your ideal payment was. Yeah. And they're like, oh. And, it was a learning curve for me, though, because what I should have said is, here's your ideal payment. This is how much house you can buy. But if you do want to go up higher,
here's where you're at.
Yeah. So that was actually a learning curve for me of how I need to communicate it. But a lot of lenders, whether it's car or mortgage, they want you to buy the most, so because it's more money in their pocket. They make money off of how much you borrow. Yeah. So you just the first thing you need to do in the process is figure out what are you comfortable paying. It's the same thing with a car. Again, if you make $40,000 a year, you shouldn't have a mortgage payment of a car note,
Yeah. Going back to that, and I will say there are some people that I don't think we operate that way, though, because we help when you help someone, which when we do, we get referrals, right? Other people say that. And I think the house buying process is not about maxing out. It's about the lifestyle you're choosing. Yes. And some of that may be having a lower payment so you have less stress. Right. You're not making job choices or financial choices. You can still go on vacation and also, afford your home. So I think talking with your clients and saying, like, what kind of lifestyle are you wanting to live? Where's comfortable? Could you push a little bit now, knowing that you're going to get a few raises, but not push too much? And having their best interests in mind, right? Serving people that way, I think is key. Talk me through a little bit. So the loan process we talked about, don't buy a boat, don't pull lines of credit, all that kind of stuff. Yeah. What are some of the things that you like to walk clients through in the home buying process as far as, I know once you get pre-approved, you get the house under contract, then kind of the real work starts of like, hey, I need to see these documents and these documents. Yeah. Is that all coming from you, or is that coming from the underwriter? Like, where's all that I need more information coming from?
Well, we'll say there's not enough education on this stuff, because a lot of people, they just kind of like, you get pre-approved, and then if you're a home buyer, first-time home buyer, I've heard of a lot of experiences where you don't hear what goes on behind the scenes. Like, what's going on? Is everything okay?
Yeah, are we still going to buy this house?
Yeah. And so what we like to do is we like to educate along the way. So every step in the process, we like to send an email that tells you where you are in the process. So like a home buyer, especially first-time home buyers, I'm very passionate about them, because I remember when I first, bought my first home, I thought this guy worked magic to get us approved. I had no idea. Now I remember I got a USDA loan, and I thought this thing was just like pure magic. And now as a mortgage lender, I'm like, oh, you used a USDA loan. But I just didn't know, because I just wasn't really educated. Right. And we thought that we had to pay our realtor hourly. So I never called her, because I was scared that if I was using her time, and as a first-time homebuyer, I didn't have money. And so I was scared to call it. So like there just wasn't education around this. Yeah. And so we focus on the education process a lot. So one of the first things, this is like my own little trick of the trade, is that I'll do a Zoom call with them, with all of our clients, with a breakdown of like, hey, here's an option, but here's another option. Like, that's one question, is like, are you getting options? Or are you fitting into a certain box, and like, this is the only box you can fit into? Yeah. So we like to do that on the front end, even before we do the pre-approval. This is like a basic buyer consultation. So once we get the loan under contract, we like to communicate with all parties, with all the agents and the buyer, to let them know, hey, this is this is moving forward. What we do is send out an initial document checklist to the buyer. Like you, at this point, I should already have like your basic documents, your W-2s, your pay stubs, bank statement, all that sort of stuff. But then we'll send a checklist. So that will come from myself and also my assistant. And so from there, we'll get that checklist. And that's pretty much anything that I may have missed on the pre-approval process to get the ball rolling. So the contract, the earnest money check, all that sort of stuff that I wouldn't have gotten on the pre-approval. After that point, it gets sent to processing. The processor is not the same as the assistant. The processor is looking at your file as a home buyer, saying, okay, this is everything an underwriter is going to look at. Their goal is to poke holes back to the loan officer and say, hey, we missed this, this, and this. Let's get
get it ready for the underwriting.
So their goal is to package the loan, your loan as a home buyer, for an underwriter to give the okay. And so once they do that, the processor will send it to underwriting. And then again, an underwriter is looking at that loan to say, would an investor want to buy this loan? Is all the boxes checked? From there, the underwriter this is all behind the scenes, so I don't know if everybody cares about this, but the underwriter will either give an approval and a conditional approval. But if he gives a conditional approval, basically it's like, hey, overall your loan is approved. We just got a couple things that we need to.
I need to see 2 more W-2 pay stubs.
Yeah, or like, hey, on your credit report, this address popped up. Do you own this house, or was this like you were just getting mails sent there? They'll just ask a question like that, or hey, your driver's license is about to expire. Let's get an updated driver's license because it's going to expire before we close.
Right.
That happens a lot, by the way, because like who actually looks at their expiration date?
It's just like when the officer says, "Can I see your driver's license?" You're like, "Oh shoot!"
Yeah,
that's when you look at it.
So. So from there, the underwriter will throw the file back to the loan officer and the processor. The processor will then ask the home buyer, hey, the underwriter asked for X, Y, and Z. Can you send that over to me? Get that sent over back to underwriting for clear to close.
That's awesome.
Mm-hmm.
Yeah, each of those steps, like I said, it's like, why do you need this doc? And having someone, a great mortgage lender like yourself, on the other aisle saying, hey, I need this doc, but here's why, I think helps keep the process smooth. Yeah. So last I wanted to talk about, I have a lot of people I work with who are, they have their first home.
Yep.
They're actually looking at buying another home and either turning their previous home into a rental. Can you get 2 loans?
Yeah.
Or also, if I have a current home and just want to buy a rental, can I do that with a conventional loan?
Yeah.
And how many can I do that way?
Yeah.
With a W-2?
Yeah. So what I would say, like I wish I would have started at like a younger age of like home buying, but I honestly, I just didn't understand it. Like, again, there's just not enough education on it. I think there is more now. Like, I think you can learn a lot, especially from like YouTube and honestly podcasts like this. But at the time, there just wasn't enough information. But if I could go back, if I was like in my young 20s, I would buy a house every 2 years. And especially if you're not married and you don't have a lot of responsibilities, you don't have kids, you don't have like, other things. Not that those things are bad, by the way. But like when you do have a wife and kids to throw into the mix, it's a lot harder to say, hey, honey, we're going to move every 2 years.
Yeah.
We got to think about the districts that our kids are going to, live in and grow up in, school system, all that sort of stuff. So what I would do is I would buy a house, and then 2 years from that point, I would buy another house. I would keep that first house, and I would rent it out. Mm-hmm. We can use, as a mortgage lender, 75% of that income to offset the mortgage that you're paying on that. So you can accumulate a good bit, and by the way, you should be charging at least that when you're leasing it out to cover all your expenses. So we can use 75% of that. All we need is the lease agreement, and if you've had that property rented out for longer than a year, we need those tax returns to see that you're what am I trying to say?
That you have the income coming from that property
You're
to
getting
justify.
yeah. So
now the question I have on that. So when I did it, circling back to like buying too much home, it was funny when we did our first move. I thought to myself, I said, I bet the bank will lend me more than they should. and they did, basically, in a way. I did take our primary residence. We moved out of it, bought a house in Homewood, and turned the old house into a rental.
Okay.
At the time, I had to have coverage income for both properties.
Okay.
They said my DTI would not drop off of that only after a year of income showing that.
Mm-hmm.
Are you saying that in this scenario that you don't have to have that year, you just have to have a lease in place?
Yeah, we just need a lease.
Wow. Okay. Yeah. So maybe rules have changed.
Yeah.
I'm sure those things are always changing. But when I did it, it was like, no, you got to cover both. Your DTI has to cover both of these properties.
Yeah. So and not all lenders are the same too. So some lenders that might be an overlay.
Yeah.
And an overlay, just so people are clear, there's guidelines, there's lender guidelines, and there's overlays. So a guideline is something that we all have to abide by. Like there's no getting around that. But an overlay is specific to what lender that you're working with. So they like one lender may say, hey, the minimum credit score is 620. Well, that's just their overlay. That's just that bank saying we will not go below that. But the guideline may state 580. So there's other lenders. That's why it's good to talk to multiple lenders, because you might be missing an opportunity, especially if you're trying to buy multiple properties, if you're not willing to talk to a couple different people to see what your options are.
Yeah. How many conventional loans can you have in your personal name?
I mean, as long as it works, you can just keep going.
Can you go 10?
Yeah.
I've heard the limit's 10, 8 to 10.
No, I mean, I'll double check on that, but I don't meet a lot of people that have more than I think the most I've seen is 3.
Yeah, I've got a couple more than that. But.
Well, because a lot of people, when they're in like doing what you're doing, you're buying tons and tons of properties, which is awesome. They move more into the private.
You get into a little more commercial. You get into hard money. You get into seller financing.
Right.
Several of my properties are seller finance. So
awesome.
You start to it's the 201, 301 of financing. But I like what you said. Definitely that. I think at the core of this whole discussion is figure out where you want to go in life.
Yeah.
Figure out what lifestyle you want to choose. If you want to buy a home, all these different things. If you want to get into investments eventually, and then just have lots of conversations with mortgage lenders like yourself. You may have those things, overlays, those positions that you're not going to accept it, but someone else might.
Yeah.
And you don't know until you have these conversations. You might find a credit union that will fund your personal home better, but they don't want to touch an investment property.
Right. That's exactly right.
And so figuring out the nuances, I think a lot of people come under this, like you said, go back to education. They get into this financing world of how to fund their next purchase, and they think it's kind of a one and done or one pathway. And there are so many ways to slice it up and fund a property.
Yeah.
And it really comes down to having a lot of conversations and saying, this is what I'm trying to do. Can I do it? And they may say, we can't, but I know Aaron Jensen can.
Yeah.
And so that's the beauty of it.
So
There's
true.
lots of different ways to make money. And you just gotta keep having the conversations.
Yeah, I definitely wouldn't accept no. And what I mean by that is like maybe it's not right now, but like don't just accept no, because I feel like when someone just tells you no and they don't like give you any next step, it's like it limits your belief system about what you can accomplish, and you just don't even know what to do after that point.
Yeah.
So you got to keep talking to different people, and they say, hey, you know what? Not right now, but in 6 months, if you do X, Y, and Z, we can get you there. And because like that is like, man, it's one of my biggest passions is to help people with their limiting beliefs, because I think I kind of grew up with that, not knowing what I could accomplish, not knowing what I was capable of, because I didn't know the blueprint to get there. I didn't even know what the blueprint looked like, but then constantly just banging on doors until someone said, hey, well, if you just try this, you can get there.
Yeah.
So I think it's the same thing with being able to purchase a home or purchase multiple homes, having an investment portfolio. Just keep on knocking on doors until someone gives you the blueprint.
Yeah. No, it's so good. And I would agree. I grew up with some of those limiting mindset, mentalities as well. And that's part of the passion of this podcast. I mean, even the title, Beyond Wealth,
I love that, yeah.
It's thinking beyond the just the wealth itself, but it's the beyond part.
Yeah.
It's like, how do we craft and figure out skill sets and grow beyond and have a limitless mindset?
Yeah.
That the wealth is the eventual creation,
Yeah.
but like it's the mindset of being beyond.
Right.
And so I love what you said there is like, don't take no for an answer.
Yeah.
And just keep next step. And that can be applied to so many places in life, but with lending specifically, it's like there is potential for you to fund whatever house, but you just may have to figure out the next step. You may have to pivot jobs, pay off debt, but you can get there. It's just you have to have a conversation.
Right.
At the end of the day, have lots of conversations with smart people like yourself to figure out how to fund your next dream.
Yeah.
So, well, I appreciate this time. How can people, if they want to work with you, get more information about mortgages and just kind of have that conversation, which I encourage everyone, if you're even considering buying a house, to have a conversation like super early on. How do they get a hold of you?
Yeah. So my email, I don't know if we can say it. Okay. It's Jensen, Jensen at nfmlending.com. But then also follow me on all socials. The tag is Alabama Mortgage Guy. So TikTok, Instagram, Facebook, whatever. I'm pretty good about getting back with people and giving everybody next steps.
Man, I love that. Definitely follow on TikTok and Instagram, all the social media. You put out a lot of education, some funny skit stuff and like kind of funny stories that have happened, but also just like practical steps, even some news updates. Yeah. So I thoroughly enjoy all the content you put out. So appreciate that as well.
Appreciate that, man.
Yeah, man. Well, thank you for the time and safe travels up to Nashville.
Appreciate it.
Take it easy, man.
All right.